Prices sometimes surge and plummet in a very short period of time. The reason we calculate the moving average of a stock is to help smooth out the price data over a given period of time by creating a constantly updated average price. Moving average is one of the most useful and common indicators for both long-term and short-term trading. It's a lagging indicator because it's based on past closing prices, so it won't give you any warnings in advance, but it will confirm when the trend has been reversed. In today's video, I will show you 3 main types of moving averages, and I will also show you when to use which moving average and how to use them. You see all of those candlesticks and the prices? They are not smooth. With the prices surge and plummet in a short period of time, there are a lot of false signals, and it's not easy to see where our entry and exit points are. But if I have a moving average shown, you can see that the line is very smooth. This is my 200 moving average right here. It's much easier to see the average value because it filters the noise from the random price movements, and now it's much easier to see. Briefly, to talk about what this average price is, let me show you the chart right here. If you want to buy Apple stocks around this day, that price is trading around $43.59 right there, but the average price is $38. So you know that you are paying more than the average price at that given time period. If I move forward, you can see right here, if I'm buying this stock on February 6th, 2018, you are paying almost the average price. So it's a good price to pay at that point. If you are paying $38 at that time, around January 2019, you are paying below the average price, which is very good. But you never know if the stock is going back up or not, right? So sometimes you really have to be careful. The price right now, it's $145 and the average price is $128. So this is the average value of the stock at a given time period. That's what this average tells you. What can we use moving averages for? We use moving averages to identify trends and confirm reversals. When the prices are trading above the moving average, it's considered as an uptrend. And when the prices are trading below the moving average, it is considered as a downtrend. When the prices break above or below the moving average line, it could imply that the trend has been reversed. But be careful, it's never 100%. This is AMC's chart right here, and you can see all of those candlesticks and all of the prices. And each candle has 4 different prices, but moving averages use the closing prices to calculate. If you're not sure what a candlestick is, and if you're not sure how we have 4 different prices on one candlestick, watch my candlestick tutorial. And now, all of these prices, they move up, and they are all above this red moving average, which is my 200 period moving average right here. And that means from this point on, this is an uptrend because the prices, they're trading above this line right here. When the prices starting from here all the way to here right here, that means this part is a downtrend because all of these prices, they're trading below the moving average right there. So this is how you see where the trend is. And for big long-term trend, we usually use 200 moving average. And for shorter time period, we can use something a little bit shorter, like 50 or even 20. And now you see those prices. Again, they're trading above the moving average right here. That means for this part, it's an uptrend. And this part right here, it's a downtrend again, because all of these prices, they are trading below the moving average. I also said that when it breaks through that moving average, for example, like this candle right here, it broke through. That could mean the trend has been reversed. From this downtrend right here, this candle broke through that moving average. So that means now the trend has been reversed from a downtrend to an uptrend right there. And I also said it's not 100% of the time. For example, this one, it broke through, but it tested back that resistance. Eventually, the trend reversed. So you really have to be careful. We also use moving averages as a support or resistance. So this is an uptrend. All of the prices are trading above the moving average, and now it's coming back. It's testing this support. It got rejected because this is the support, and it went back up. Now it's testing again, it went back up again because this is support. So eventually this candle right here, it broke through that support. So now this has become a downtrend. And this moving average is acting as a resistance now. But now, when this candle is testing the resistance, it broke through. So again, this becomes an uptrend. And you can see that this uptrend is rallying. And now, again, it's testing this support. This time, it went back up, but eventually it tested this support again, and it broke through. And now, it has become a downtrend right there. You can see that. This moving average is acting as a resistance. And right here, as it's closing on the moving average, and it broke through, and now it becomes a support. Support right there, it's rallying. It becomes an uptrend now. So this is how you use moving averages as a support or a resistance. And always remember, it's not 100% of the time. There are three main types of moving averages: simple moving average, weighted moving average, and exponential moving average. Allow me quickly show you how simple moving average is calculated. Let's say we have some numbers right here, or just prices here. If we are calculating a 5-period moving average, we would use the first 5 numbers, and that is 5 plus 6 plus 7 plus 4 plus 8, that equals to 30. Now, because we have 5 numbers, we use 30 divided by 5, and that is 6. So the first number of our moving average is 6. Then we use the next 5 numbers, that is 6, 7, 4, 8, 6. And that equals to 31. And 31 divided by 5, so the second number is 6.2. And we are going to calculate all of the numbers like that. So the first 5 numbers, then the second 5 numbers, then the third 5 numbers, all the way to the last 5 numbers. And we're going to get all of those numbers, and that would be a 5-period moving average. And if you are calculating a 10 or 20-period moving average, you would have to use the first 10 numbers or the first 20 numbers, and you add all of them and divide it by 10, 20, and then you would get that moving average of your specified time period. Remember that the longer the simple moving average period, the more lag we have and the slower it reacts. So the problem is that equal weight is given to all periods, and the simple moving average responds slower to rapid price changes. Now, how can we fix that? We can use a different type of moving average. We can use either weighted moving average or exponential moving average. Weighted moving average and exponential moving average are calculated differently, but both of them give more weight to recent periods, and they emphasize more on what the traders are doing right now. So basically, weighted moving average and exponential moving average, they would respond faster to price action by giving more weight to recent periods and less to older periods. They would show you a faster shift in sentiment. Besides the types of moving averages, you need to choose a time period so you can analyze the trends more precisely. I use 9 to 21 time periods for short-term trends, 50 for mid-term trends, and 200 for long-term trends. Let me show you different time periods. This is my moving average, and this one is 200 moving average, and I use this one to look for long-term trends. And you can see right here, it's a downtrend. I can change different length, 5 period, 9, 20, 50, 120 period. And with different colors right here, you can choose to show which one, and they represent different time periods. Now this is PayPal's chart, and you can see right here, this cyan color blue, that is 9 period moving average. The orange one, that's moving average, 20 period. This blue one is 50 period moving average, and this longest, this red one is 200 period moving average. So the faster one would be the 9 one, the fastest. This one shows you right here, there's a short downtrend right here. But whereas if it's 50 or 200, it shows you it's still an uptrend. It's less sensitive than the 9 period, where it shows you right here it's a downtrend. The 20 moving average, it also shows you that there's a downtrend right here, very short downtrend. But the 50 and 200, it shows you an uptrend. So this is the difference with different time periods for moving averages. When people say moving average, most of the time they mean simple moving average. Otherwise, they would say weighted moving average or exponential moving average. Use exponential moving average for short time frames and a fast moving market because it has more weight on recent prices. Use simple moving average if you are holding a position for a long period of time. It could be months or even years. Because if we use exponential moving average, you might be too sensitive and give you false signals. And also, if you just want to filter out noise, you may use simple moving average. And right here, if I'm holding NVIDIA for a long period of time, I would use a simple moving average. And this is my 50 period moving average, and this is my 200 period moving average. If I want to day trade NVIDIA, let's say I'm going to be looking at short time frame, this is 1 minute, and that means every candle is 1 minute. And I would be using EMA, exponential moving average. If I'm day trading, right here, the purple one, that's my 9 period EMA, and this salmon one, this red one right here, and that's my 21 period moving average. So that means if I'm day trading, I would be using EMA because it responds faster. In conclusion, there are 4 things to remember about moving averages. 1. We use moving averages to identify trends and confirm reversals. 2. We use moving averages as a support or resistance indicator. 3. We use simple moving averages for longer period of time and exponential moving averages for shorter period of time. And lastly, most of the time, we use 9 to 21 time periods for short-term trends, 50 for mid-term trends, and 200 for long-term trends. Thank you for watching, and if you like this video, please hit the like button and subscribe. This is Grant. Trade and invest responsibly.